So good morning, everyone, and welcome to today's webinar covering SDLT. My name is Lucy Quick, and I'm the Digital Marketing Manager here at InfoTrack. I am delighted to welcome back Sean Randall, partner at Blick Rothenberg and stamp duty expert, who will be reviewing the recent updates to SDLT and sharing important information for conveyancers to be aware of. So before we begin the webinar, I would just like to draw your attention to the Q&A tab, which is located at the bottom of your screen. You should see a little pop-up. We will be running a Q&A at the end of this session, so please type any questions you might have for Sean along with your name into the Q&A box. That way, if we do run out of time, we can extract your information and Sean will follow up with you individually after the webinar. We've already received some questions already, so I imagine there will be quite a few more to come throughout this session. So I will now hand over to Sean to present. Thank you.
Thanks, Lucy, and good morning, everyone. Happy Finance Bill Day. It was published earlier this morning. Thank you so much for giving me your time, particularly during such a busy season, really. I'm going to talk to you for about 30 minutes, 40 minutes, no more. Giving an opportunity for questions at the end. If we don't have time to do all the questions, then, as Lucy mentioned, I'll deal with them offline. So, my name's Sean Randall. Those are my details and credentials for those of you who don't know me. So, this is what I intend to cover, and it's really a catch-up of that which is relevant since I last spoke to you in September last year. So of course we've had the budget only recently, and I don't think we need to spend too long on that. But we will also have in a couple of weeks a new surcharge, and it's worth spending some time understanding how that will work. And we'll look at cases, really important to understand what's going on in the world of cases for stamp duty land tax, and then finally some closing remarks and topical issues. All right. Let's look at the budget. So really, so far as stamp duty is concerned, there were two big announcements. One is the holiday and another, a couple of new reliefs. So the holiday, I'm sure you all know what's happened, but just for the one or two of you who perhaps don't, the stamp duty holiday that was announced last year has been extended. So it was due to end on the 1st of April. And of course, now it will not, it will end on the 1st of July. So the first £500,000 of the price will continue not to suffer any stamp duty land tax. And that's worth £15,000 per property. So instantly, therefore, for those of your clients buying family homes with annexes, in some circumstances, perhaps not all, that might be worth twice as much. So 15,000 for the main home and 15,000 for the annex. But then what wasn't announced, at least trailed in the papers, but announced on budget day, of course, was a further holiday, perhaps a half holiday, which is that the first 250,000 will be taxed at 0%. And that will apply to transactions completing after 30th of June this year, but before 1st of October. So another 3 months at a reduced threshold, but still a doubling of the standard threshold, which is 125. And that's only worth 2,500 per property. So what was one large cliff edge has been replaced, and by two mini cliff edges, if you like, or certainly one slightly smaller one and one very small. So the one that was due to end or due to happen in April has been kicked down the road until July. I expect that's still likely to be regarded as the main cliff edge. How many transactions around the country, particularly in London and the southeast, are under 500,000. So there'll be enormous pressure still, unfortunately, for people to complete before 1st of July to benefit from the maximum stamp duty holiday. And that's really, designed to have helped people already in the system. But of course, because it's such an extension, that's going to attract new entrants to buying property, and the logjam will perhaps ease a little bit now, but I expect will get worse as we get closer to July. First-time buyer relief, and that's a complete relief up to 300,000, will restart on the 1st of July. Of course, it doesn't have any effect whilst we have a £500,000 holiday, but when the 1st of July stamp duty holiday kicks in, the 250, well, there's 50k which will be relieved under first-time buyer relief. So watch out for that restarting for first-time buyers. And that is the possibility, this is likely to apply to a very small number of people, but there is a possibility of benefiting from that holiday, even if completion happens after 30th of June this year, by substantially performing the contract. And that really is going to be very difficult because it involves either paying virtually all the price or taking possession before 1st of July. And in cases of new leases, there's also the possibility of perhaps paying some ground rent before 1st of July. But there are problems with each of those, not least commercial problems. All right, let's look at the reliefs quickly. So quite a esoteric relief for one particular type of body, a housing cooperative, and they're going to benefit from ATED relief, the annual tax on envelope dwellings, and the relief from the flat 15% stamp duty rate, the anti-enveloping rate, with retrospective effect from last year. But more importantly, perhaps, there will be a new relief for purchases of commercial property in designated Freeport tax sites. And although we have the 8 Freeports, we don't yet have the designated tax sites yet. They're to be designated by regulations, which so far as I'm aware haven't yet been published. But that will not be an opportunity for people to redevelop commercial property into residential. That's part of the condition. It must remain commercial, trade, or trade-related property only. Okay, let's look at the surcharge. Or another surcharge. Of course, we have an existing 3% surcharge for purchases of additional dwellings. This is a new 2% surcharge, and it's specifically going to apply to non-residents. So those individuals and companies that are regarded as non-resident in the UK. But it will only apply to purchases of dwellings, and it will only apply to dwelling purchases in England and Northern Ireland. So it will not apply in Scotland or in Wales. So what is a non-resident, and when will it apply? Well, it will apply to dwelling purchases completing after the 1st of April, or strictly after the 31st of March this year, so on or after 1st of April, unless exchange happened before budget day last year. So I expect that's going to apply to pretty few transactions. And even then, if exchange did happen before 11th of March last year, there cannot be or have been any variation to the sale contract after that date. But also it will apply, or not apply, I should say, to transactions completing on or after 1st of April if the contracts were substantially performed before 1st of April. So there are still a couple of weeks possibly to consider the concept of substantial performance for those who might be affected by this. All right. So 2 tests. One is specific to stamp duty land tax. That's the test for individuals. And the other is for companies. So there are 2 tests depending on what type of buyer buys, whether it's an individual or a company. As I say, for individuals, it's a new specific stamp duty land tax test, and it is based on counting days, whereas for companies, it's aligned for the most part to the test for corporation tax. And we'll look at both. Okay, for individuals. So the test in the first part, at least, is to look back at completion, look back over the previous year and count how many days the buyer, if it's an individual, and if there's more than one buyer, this test has to be applied to all the buyers, otherwise the surcharge will apply in full. So count the number of days that the buyer was resident in the UK, any part of the UK, at midnight. And if they were resident at midnight in the UK for at least 183 days, they will pass this test. If not, then regardless of their nationality, their domicile, their intention, and their income tax residency status, regardless of all of that, if they don't pass that 183-day count test, they will fail the residency test, and therefore they will suffer the 2% surcharge, subject to very few exceptions, which will take literally minutes to cover. But that's not the end of the story. So if they are non-resident and suffer the surcharge at completion, there is the possibility of becoming UK resident after completion and therefore reclaiming that 2% surcharge. Let's look at how that works. So here's the first part of an example. Someone completing on the 1st of April, exactly the start date for this surcharge. We look back strictly 364 days before that date, count how many days they were present in the UK, any part of the UK at midnight. And in my example, the total number of days present in the UK in that 1 year period was less than 183. So they pay the surcharge. But then we're able to look forward. So here, firstly, we construct a 2-year window spanning the completion date. So 1 year before, 1 year after. And in that 2-year window, we're able to identify any 365-day period and count how many days they're present in the UK in that 365-day period. If we can find a period, a 365-day period in that 2-year window where the individual was present in the UK for 183 days or more, which in this example we can, then they can reclaim that 2% surcharge. And the mechanics for doing so haven't yet been published. I think we're still waiting for the HMRC guidance, although it might have been published at the start of this week. And I expect there'll be various webinars and podcasts or all manner of things to explain how this works in generic terms, at least with some examples. But you get the gist, hopefully. You can reclaim the surcharge by becoming UK residents. So really what that means is there will now be 2 triggers after completion where individuals can reclaim SDLT up to 5%. So they can reclaim 3% surcharge, which already applies if they dispose of a main residence and live in the purchased property as their new main residence. And also they can reclaim a 2% surcharge by simply staying in the UK for the requisite number of days. So exceptions, very few, really only 2 for individuals. One applies to members of the armed forces and other types of Crown employees. So that might extend to civil servants, for example, who are resident offshore due to their work, and it extends to their spouses too. So if an individual fails to pass the residence test by virtue of their employment status, limited to Crown employees, of course, and they must pay UK income tax, then they and their spouses are regarded as UK resident. But it also applies to non-residents who are married or in a civil partnership with a UK resident, provided that they buy jointly. So Stamp duty rewards marriage and enables non-residents to not suffer the 2% surcharge, provided that they buy with their spouse or civil partner who is UK resident. Okay, for companies, well, it's initially very simple. So if the corporate buyer is either incorporated in the UK or controlled from the UK, then initially they're going to be treated as UK residents. And if they're not, they won't. And the company will be liable for the 2% surcharge. But, and this is where it gets tricky. So for UK companies, as I say, those incorporated or controlled from the UK, it's then necessary, or will be from 1st of April, it will be necessary to trace through their ownership structure. If they're a close company, and close for this purpose means controlled by 5 or fewer participants. So if they're closely held and they're a UK company, then you have to identify whether they're directly or indirectly controlled by a non-resident, whether that's an individual or a company. And doing so can be tricky because there are particular anti-avoidance rules which attribute rights of control in certain circumstances. So really, it's not as simple as checking who the ultimate beneficial owner of a UK company is. And it may well be the case that a UK company is initially controlled by a non-resident who itself is controlled by a UK resident. But as soon as you have indirect or direct control by a non-resident, then the UK company will suffer the 2% surcharge. Very few exceptions, and they really apply to PAIFs and REITs, so UK funds. So the only real benefit for companies or let out is the existing flexibilities. So those are the second and third bullet points here. They refer to the situation where 6 or more dwellings are purchased in a single transaction. Now that might mean a single building that's composed of more than 5 studios, or it could apply to the purchase of 6 freehold houses scattered around England and Northern Ireland. Buying 6 or more dwellings in a single transaction is not surcharged, and nor are mixed-use transactions. So again, that might mean a single building that's composed of residential and commercial premises, or it might mean a mixed portfolio of property where there's exclusively residential buildings being bought with exclusively commercial buildings. So in those cases, those types of transactions are not surcharged. They don't suffer the 3% surcharge at the moment, and they will not suffer the 2% surcharge going forwards unless stamp duty, land tax, multiple dwellings relief is claimed. Let's look at how that works. So for mixed transactions or mixed use buildings, the revenue except that the 3% surcharge doesn't apply even where multiple dwellings relief is claimed. That's really important. So that was a change in their practice published late last year, and already some people have made reclaims to recover the difference between the standard rates and the higher rates, or the surcharge, where people have claimed MDR on mixed transactions within the last 4 years. But, and here's the twist, if you study the legislation in the regulations, now the finance bill, you'll see that for mixed transactions or mixed use transactions, the 2% surcharge will apply where MDR is claimed. Now it's best to look at an example of how this will work. So let's look at one building composed of 4 flats in the upper parts and retail premises on the ground floor. So 2 million of the purchase price is attributable to the flats and 50k to the retail premises. So let's work out whether it's better for the buyer to claim MDR or instead pay tax at the non-residential rates. So the buyer is a UK company, but it's controlled by a non-resident. So therefore the UK company will suffer the surcharge. So we tax the average price per dwelling, which is 500,000 at the standard rate without the surcharge. And if this transaction completes before the 1st of July, well, there's no tax to pay at the standard rates. But remember, there is a collar or minimum amount of tax for multiple dwellings relief, which is 1%, a flat 1% of the dwelling price. So of the 2 million taxed at 1%, 20,000 will be taxed. But then because the company fails to pass the UK residence test, the non-resident 2% surcharge will apply. So there's the difference. So the 2 million will suffer the 2% surcharge, which obviously gives you 40k. Then we need to add the tax on the retail premises, which is 2.2 roughly, to give a final tax figure with MDR of 62 or 62.62 roughly. Whereas with the non-residential rates, the tax would be 92,000. So still better, but there's a mismatch there between the 3% surcharge and the 2% surcharge with regard to claiming multiple dwellings relief on mixed use transactions. Okay, so the rates, they were complicated, they become even more complicated, and that's the result of firstly, the difference between residents and non-residents, but also now with 3 different sets of rates for each, for the most part at least, depending on when a transaction completes. So H1 refers to holiday 1, transactions completing before 1st of July. H2 refers to holiday 2, so for transactions completing on or after 1st of July and before 1st of October. And then the last column for each, the slash, is obviously for transactions completing on or after 1st of October. So there's a real difference in rates from 5 to 17, as you can see. So 12% rate delta, if you like, rate difference. And you can see the flat super rates for corporate envelopes will become a flat 17% rate. Whereas transactions in mixed property and transactions in 6 or more dwellings will continue to be taxed at a top rate of only 5%. Good luck. All right, let's look at a bit of case law. So since I last spoke to you in September, there have been no new cases so far on mixed use. So those 4 cases on country properties with paddocks and adjoining land continue to be the main cases on the boundary between what is residential and what is mixed use for 4 cases of that type. And really, in a nutshell, those 4 tribunal cases basically say that you need to understand and identify what the functional relationship is between the adjoining land or the paddock and the main house. And unless it serves some kind of identifiable self-standing function, perhaps because it's used for grazing or some kind of agricultural activity, then it is going to be treated as part of the grounds of the house and therefore exclusively residential. It's much more nuanced than that, but in a nutshell, that's what those 4 cases decide. Now, those cases are likely to be appealed, I think, at least most of those cases will be, to the upper tribunal, which is effectively the High Courts, and we'll start to get some binding precedent on what the boundary is. But remember, those cases, for the most part, were on relatively weak facts, in my view, so I'm not expecting those decisions to be overturned. Equally, there have been no new cases on when a derelict or damaged property ceases to be regarded as a dwelling. So we've had a couple of cases, Bewley in particular, but also Fish Homes, which identify in what circumstances a dwelling ceases to be a dwelling because it's no longer suitable for use as a dwelling. Those are the words, suitable for use. And really, you need a very high threshold, or need to meet a very high threshold in terms of a building that was used as a dwelling, possibly will continue to be used as a dwelling, or at least after refurbishment, before that type of building is taxed at the non-residential rates. There have been 2 new cases, though, on purchases of family homes with annexes. Doe and Partridge, again, they're first-tier tribunal cases, and they really just affirm earlier decisions, particularly the decision in Fiander. And they really say that, look, for an annex to be eligible for multiple dwellings relief, it has to be objectively suitable for use as a single dwelling. And in those cases, now 4 cases on annexes, the relevant annexes were internally connected to the main house without some kind of partition. And the argument that suitability could be qualified by the existence of a trusted relationship, maybe a family relationship or a staff relationship, were dismissed. So clearly the issues of privacy, security and safety are relevant. And unless the annex can meet those kind of tests, because there is a lockable door preventing the occupants from one part entering the other part of the building, then that annex will not qualify. And then we have, which is much harder to discern because these types of decisions, these county court decisions, are not published. We have professional negligence claims against solicitors for failing to advise buyers on the possibility of claiming multiple dwellings relief on the purchase of annexes before 2016. And the significance of that date is, in my view, really the only objectively arguable date when this practice of claiming the relief on annexes emerged. So almost by definition, in my view, failing to advise someone before 2016 that the relief could be claimed on the purchase of an annex before 2016 really cannot be negligent, because people like me and other stamp duty specialists were not of the opinion that the relief was available. So how on earth could a residential property lawyer spot the opportunity? And the county courts have started to agree. So we've had at least 3 cases. Again, they're quite difficult to pick up because they're not published, but I'm aware of at least 3 cases since I spoke to you last where the county court judge has ruled in favour of the law firm and dismissing the claim for professional negligence. But so the but is that there are more cases coming. So there's quite a pipeline, I understand, and that pipeline is going to spit out quite a few cases over the next month or 2, as I understand. So I'm expecting cases on more farmhouses, both appeals in the 4 cases I mentioned, but also new cases on farmhouses and agricultural properties in the context of mixed use. I will also expect, I am expecting appeals in relation to claims for multiple dwellings relief on purchases of bare land and commercial premises with permitted development rights, where the process of adapting or constructing the residential units was not in progress at the completion date. So that's simply based on the future intention of the buyer. Then there'll be, I think, I understand, some appeals on annexes, again, in the context of multiple dwellings relief. And here, I believe the annexes in question have no kitchen. And I think it might shock you to understand that I'm not very optimistic about the chances of success in those decisions, in those cases rather. Then there are also likely to be decisions or appeals in the context of various arguments being made that the presence of one or more of these factors can pull a transaction into the mixed use rates. That is, flats with some kind of interest or right over communal gardens, the possibility of a lockout agreement, right of preemption, reservation agreements, or wayleaves over the purchased land. And again, anecdotally, there is a relatively large amount of activity on the part of reclaim firms arguing that those factors enable people to make reclaims due to the fact that the purchased property is in fact partly residential and partly non-residential. I very much doubt the revenue agree, and I am expecting decisions of the tribunal relatively soon on one or more of those fact patterns. Certainly there's already been one, I know, in relation to communal gardens, which the revenue has won and has not been published. Okay, so a few closing remarks before we go on to questions. So the types of issues that we discussed in September continue to be relevant. So the meaning of dwelling, single dwelling, and garden and grounds, which are used in the legislation, the stamp duty legislation, for the description of a residential property, are clearly still important, and it will become even more important clearly because with the 2% surcharge applying from April, that rate difference is being extended and increased. So even more pressure to understand and apply the rules regarding derelict dwellings, annexes, guest suites, staff flats, and adjoining land. But there is a very high threshold that's been established in all the cases so far, and quite rightly, and I imagine that's going to continue to be the case. Also, unarguably, the burden of proof is on the appellant. So the buyer will have to show ultimately to the tribunal or court satisfaction that a derelict dwelling is not suitable for use objectively as a dwelling, or an annex is suitable for use as a single dwelling, or that adjoining land is not part of the grounds of the house. So those two things, high threshold, factual, evidential threshold, and also the burden of proof combined means that this is really quite tough. And also quite rightly, HMRC recognises the risk to the collection of revenue and are enforcing these types of transactions pretty vigorously. So what to take away from all of this? Well, I would highly recommend that you put in place controls for fee earners to identify in what transactions, in what cases that 2% surcharge could apply. So there will need to be some kind of audit trail, some kind of checks and balances to spot particular cases where an individual or a corporate buyer is not resident and therefore will be liable to that 2% surcharge. Sorry about that, but it's going to become even more complicated. Also, continue to understand and apply the boundaries for multiple dwellings relief, mixed use, and 6+ transactions. By 6+, I mean the purchase of 6 or more dwellings in a single transaction. Those are still really important and the most obvious triggers really for encouraging buyers possibly to seek specialist advice, because the difference in tax treatment can be so large. And then finally, well, continue to keep track of those tribunal cases. They will clear the boundary in terms of what constitutes mixed use, what constitutes qualifying annexes. The boundaries will become clearer. And so, yeah, do keep track of those tribunal cases. Okay, maybe a little bit ahead of time. Lucy, I'm going to move on to questions if there are any.
Thank you very much, Sean. Yes, we do have quite a few questions, so we'll get started. Are you able to cover the latest position on MDR where there is part commercial on the transaction as well?
Yeah, so I think I covered it to some extent. So for some time, people have been of the opinion that where you claim multiple dwellings relief on a mixed use property, so partly residential, partly commercial, the way the legislation is worded is that because the subject matter, the property isn't or doesn't consist of exclusively residential property, then you don't pull in the 3% surcharge. And so when you work out your MDR calculation, when you work out the tax due on the notional average price per dwelling, you take into account only the standard rates, not the higher rates or the surcharge. And I drew a distinction because I think it's very easy to miss that going forwards for non-resident transactions, for mixed properties, when you do your MDR calculation, you don't take into account the 3% surcharge, but you do for the 2% surcharge, just due to the way in which the legislation is worded slightly differently. The Revenue published guidance, I think it was in November last year, which confirmed, after some time, they confirmed unequivocally that they accept that the 3% surcharge does not apply on mixed use transactions where you claim the relief, multiple dwellings relief. But they gave a caveat, understandably, that where the commercial element is contrived or negligible, I forget exactly the language, but I think it's pretty much those words, then they will not necessarily agree. So there needs to be some element, meaningful element of the price attributable to the commercial premises. Hopefully that answers the question.
Thank you, Sean. When a property is owned by a husband with the mortgage, and when the wife gets added to the title, would the wife get a liability for SDLT?
Okay, so thank you for that. It's quite a common fact pattern, so transfers of equity between spouses. And the answer is that yes, unless the amount of debt which is assumed by the wife, and the amount of debt will be the outstanding debt corresponding to her share that she will hold in the property after the transfer. So if it's going from husband 100% to himself and his wife 50-50, then the wife will be treated as assuming 50% of the debt. The surcharge, the 3% surcharge, will not apply. There is a particular exception to the surcharge for transfers between spouses. So therefore, you're within the standard rates. And of course, up until 1st of July, we've got a pretty generous, very generous stamp duty holiday, which will exempt £500,000. So equity transfers before 1st of July may well attract no tax at all.
Thank you. If a deposit is paid and an unconditional mortgage offer is made for the balance prior to the 31st of March, can 2% surcharge be avoided by a non-resident, or only if contract substantially performed, i.e. possession or 90% purchase price paid?
Yeah, so thank you for that. You better get your skates on, whoever's asked that question, because the possibility of legitimately getting grandfathered or protected from the 2% surcharge only applies where contracts are substantially performed. So the concept of substantial performance hasn't changed, and the legislation refers to one of three things. So either taking possession of the whole or substantially the whole of the purchased property before, in this case, 1st of April, or paying a substantial amount of the consideration, which the Revenue have, since the inception of SDLT, said, in their view, constitutes 90% of the purchase price. And thirdly, thirdly, it's an alternative trigger, but it only applies to grants of leases where the first payment of rent is made. But there is some doubt whether one can pay rent under a contract. It would need to be some kind of equitable agreement for lease before the lease is formally granted. But in essence, therefore, you really need to pay to be sure that this tactic will work. You need to take possession, or the buyer would need to take possession, pay 90% or more, or pay rent before 1st of April. I mean, clearly for most transactions, that's not going to be possible. But interestingly, I wrote an article for the Times before the holiday was extended and referred to this possibility. And at least 5 people came to me and said that they're interested, and actually paying the price, 2 weeks before completion for them was possible and would be beneficial in saving the stamp duty. I've just been joined by my cat. So hopefully that answers the question.
Thank you, Sean. If I act for a company where there are 2 directors and 1 director is a resident abroad, is the company liable to the extra non-resident SDLT liability?
Well, answer probably depends a bit more. So it depends on control, which is really a test on shareholders, but I assume in this example, the directors would also be the shareholders. If the shareholders are related, then yes, there's a particular rule which attributes rights of control. So if they're connected or spouses, the 2 directors that is, there may well be the possibility of control infecting the transaction and the surcharge becoming due. But if the directors are, or shareholders I should say, are not related or in marriage and neither controls individually the company, then the answer should be no. But there's some particular rules that need to be gone through.
Thank you.
Thanks.
Can you please confirm the SDLT position with someone who is purchasing a residential buy-to-let property but does not own any other property?
Okay, well, it's very simple, which is that you can forget the surcharge. The 3% surcharge. I keep using surcharge in the singular. Now we're going to have to refer to surcharge in the plural. But you can forget the 3% surcharge, because although the purpose of the purchase is investment, to buy a buy-to-let, that's not enough to trigger the 3% surcharge. It actually refers to ownership of another property. And even then, there are some, exceptions for replacing main residences. But in this case, the fact that the purchased property will be a buy-to-let doesn't automatically engage the surcharge. In fact, it doesn't engage the 3% surcharge at all, because fortunately, the buyer doesn't own an additional property, doesn't own any other properties. So in that case, go back to the standard rates, and particularly before the 1st of July, we've got some pretty generous pretty generous threshold for when tax becomes payable, and hopefully that shelters a lot of tax for the future investor.
Thank you. Do dwellings include freehold ground rent investments?
Yes. So if the freehold relates to a building that's composed of or includes residential, then the freehold would be regarded as a residential interest. If it relates to a building that's partly commercial and partly residential, then it will of course relate to a mixed purchase. But if the reason for asking the question is, does that engage multiple dwellings relief, the answer almost certainly is no, because there's an exclusion from that relief where the purchased interest, here the freehold, is reversionary on long leases. So if the flats have been sold off on long leases and all that's being bought is the ground rent reversion, well, even if the freehold interest relates to 20 residential flats, unfortunately that purchase is not going to be eligible for multiple dwellings relief because none of those flats you know, are on terms, the freehold would be reversionary on long leases. So really you need, for a reversion to be eligible for MDR, the relevant flats need to be let on ASTs, or certainly shorter leases, not leases of 21 years or more. I think it might be more than 21 years. But pretty clear that the relief won't be available in that example.
Thank you, Sean. What is the procedure for claiming relief on the purchase of a derelict property?
Oh, okay, lovely question. There is no relief. So it isn't a question of claiming a relief. It's not a question of satisfying conditions, self-assessing that the relief is available and putting a particular code on the return. The argument is that the building that's being bought is not used as a dwelling or suitable for use as a dwelling or in the process of being constructed or adapted for use as a dwelling at the completion date. So if it's really derelict, and by that, you know, the right threshold probably is objectively uninhabitable rather than tired, in need of refurbishment, in need of modernization, you know, in need of a new kitchen or toilet, that's not going to be enough, really. You need some kind of structural repair or some kind of structural problem, perhaps asbestos, really to satisfy a tribunal that that is not suitable for use as a dwelling. But where it isn't suitable for use, where it's objectively unsuitable because it's uninhabitable or condemned or, you know, being taken out of council tax, for example, then you don't claim a relief. Instead, you self-assess that actually what you're buying is non-residential.
Thank you. Does the 2% surcharge apply when claiming the relief for collective enfranchisement claims in respect of acquisitions of freehold by tenants?
Yes, really good question. So this really draws out in the extreme the kind of hard-edged effect of the 2% surcharge. So it bites, it's all or nothing if a single buyer in a situation where there's more than one buyer satisfies or fails to satisfy the residence test. So in a collective transaction, collective enfranchisement transaction, if one of the participating flat owners is non-resident, well then that means the whole transaction is a non-resident transaction. There's no de minimis, there's no apportionment rule, there's no exception for this type of transaction. So there will be enormous pressure for that flat owner to refrain from participating, given that it will affect the whole purchase price. The revenue are aware of this, or the government, I should say, are aware of this and have stated in their response to the consultation on the 2% surcharge that they will consult on specifically this type of transaction to understand whether this is going to impact negatively on people entering into this type of transaction. That process hasn't started, and I wouldn't anticipate any changes initially. So the earliest I expect that there might be changes might be next year, for example, but there's some way to go before persuading the government that this rule should be amended.
Thank you, Sean. Would it be sensible to advise clients to seek advice from a tax specialist where any part of the property is used for non-residential purposes or may consist of more than one dwelling?
It may shock you to say that, for me to say, to understand that I would say, yeah, seek advice in that situation. It's very self-serving, of course, yeah, but look, I'm really sympathetic, you know, to the knowledge gap between the level of knowledge that you need to apply these rules competently, effectively, and the level of knowledge that residential property lawyers with the most respect have regarding tax rules. And, you know, if I find this a challenge and dynamic and stimulating, which I do, then I dread to think what it's like being on the ground doing conveyancing for a fixed fee with huge pressure on margins. But there it is. It's impossible to exclude liability. Those are pretty good thresholds or triggers for perhaps testing whether specialist advice is necessary. So mixed transactions, purchases of more than one property, those two, and derelict dwellings also perhaps would be another trigger. And that isn't necessarily the case that the relevant specialist would immediately go on the clock and start charging. But yeah, I would do some research and encourage the buyer to understand whether specialist advice would be a good idea in those circumstances.
Thank you. Can general HMOs be classified as multiple dwellings for MDR or non-residential if more than 6? Is it any different to student accommodation where it does appear to apply?
I don't think it is different if the interior configuration is similar to a cluster flat for student accommodation. So if, which isn't usually the case, of course, but if you could argue that there are clusters of bedrooms with shared kitchen and bathroom facilities with their own front door, then each cluster ought to be regarded as a single dwelling. But if it's a simple house, you know, set up as an HMO and run as an HMO, then that would just be treated as one house. You know, you need, understandably, you need kitchen and bathroom facilities per dwelling. And so it's not the case even where there are clusters that each bedroom would be a separate dwelling. Each cluster would be a separate dwelling. I haven't seen many HMOs in practice where this kind of argument is possible, but it depends on the facts. And I do recall about a week ago, coincidentally, of a developer intending to develop or redevelop existing residential property into C4 HMO class style accommodation with some communal living space, but they were intended to be clusters. So yeah, there's more than a fighting chance, I think, in those circumstances for the relevant test to be met.
Perfect, thank you, Sean. If a client already owns a buy-to-let property and they decide to purchase a property for their main residence, will the main residence be liable for the 3% surcharge?
Yes, because they own another property, and the fact that they intend to purchase or tend to use the purchased property as their home isn't enough in isolation, but they could reclaim the surcharge if they dispose of a property that had been used as their last home within 3 years. So that exception for replacement main residences requires two things. One is an intention to use the purchased property as their home, but it also requires the relevant buyer to dispose of a property either before completion or after completion. And that sold property, or the property disposed of, it doesn't have to be a sale, must have been used as their last home within, at some point, not necessarily continuously, but at some point in the period of 3 years before the completion of their purchase. So I hope that answers that question. We're doing really well, Lucy. Are there many more?
Yes, we do have quite a few more. And just thinking of the time, should we do a couple more?
Let's do a couple more.
Yeah. Can you confirm if MDR, if buying 2 leasehold flats from different sellers within the same building and then acquiring the freehold, so leasehold will then merge?
Well, I guess firstly, the problem I would have with that is if they're buying the 2 leasehold flats from different sellers, unless the sellers are connected, it's not going to be regarded as a linked transaction. So they're not buying multiple units in a single transaction or from connected parties. So yeah, I'm not sure that the problem is the merging of the flats with the freehold later. I think the problem is that initially they're not going to get the relief on the purchase of the flats initially. When they buy the freehold, well, they'll be buying a freehold of a building that is composed of more than one flat, and then there's a second opportunity to consider whether MDR is available. I guess at that point, the argument would be, is the freehold reversionary on long leases in circumstances where those leases extinguish immediately at completion. I think the legislation refers to the end of the day of completion rather than at completion. So yeah, on a black letter law reading, I think there's more than a fighting chance that the exclusion from MDR would not apply if the flats extinguish, the leasehold interests extinguish at completion, immediately at completion of the purchase of the freehold. At least so far as those two flats are concerned, maybe the building, the freehold reversion is subject to other leases which haven't yet been determined or extinguished, in which case those other leases will not be taken into account as part of the MDR calculation. I may not have explained that clearly enough. If so, get in touch with me and I will try to do so in writing.
Thank you, Sean. And to end the session, we've had quite a few questions asking for your sort of tips and advice on how people can manage their already pressurized workload during this time.
God, what an interesting question. I'm not sure I know what to say. I think be realistic with clients' expectations. My dog agrees, if you heard that. If buyers are under the impression that they will definitely be eligible for this holiday when they haven't yet entered the system, well, I've managed their expectations. I sympathise enormously because it's going to be a very busy period still. I'm sure it is at the moment, but it will become even more busier as we get closer to the 1st of July. I don't know what to say. That cliff edge is going to stay. I don't think there's any possibility of another extension or another further holiday. It is now absolutely certain that we've got a 1st of July and a 1st of October cliff edge, and do your best.
Thank you, Sean. If we haven't been able to answer your question during this session, fear not, it will get answered offline. We are just conscious of time and we know it's a very busy time for everyone at the moment. I would just like to say a big thank you to Sean for his time today. Hope you all found this session informative. If you do have any other questions about the tips and information you've seen today, you can contact Sean directly. Or if you've got any questions about completing SDLT through InfoTrack, please get in touch with your account manager, who'll be able to assist you. I will also be sharing the recording with you, so you can refer back to Sean's presentation at a later date. All that's left to say is thank you so much for joining us. Have a lovely rest of your day and a lovely rest of your week. Thank you.
Thanks very much, everyone. Thanks, Lucy.